Understanding the theory of inducement will help you to avoid many losses, catch higher risk to reward winners, trade with higher accuracy, and ultimately create success in your trading. So in this class, I'm going to show you everything you need to know about inducement. Let's get to it. Sometimes when you look at a market, there will be multiple levels that you could potentially buy from. You may have a market moving like this in an uptrend, where there are 2 zones, or maybe even 3, to select, and you're not sure whether you should buy from this one, or you should buy from this one. Now, many times, if you buy from zone 1, you will actually see the market come down, and then trade through that level, filling zone 2, before moving in your direction, which means that you end up taking a losing trade. This is inducement. It's this area that draws you into a trade before stopping you out, before moving in your overall given direction. Now, sometimes zone 1 is going to be the right one to trade from, but sometimes it's going to be zone 2. Learning to understand inducement is how you're going to decide whether your buys should be taken from zone 1 or zone 2. That's what we're going to do right now. Now, there are 2 ways to determine whether zone 1 is going to be the good trade or zone 2 is going to be the good trade. The first is down to liquidity. Generally, we're talking about equal high and equal low liquidity. Now, to explain this concept briefly, if you don't know what it is, liquidity refers to levels in the market where lots of orders are accumulating. Equal low liquidity would simply look like this. The liquidity forms underneath the collection of equal lows. So you may see this as a support floor, which is pretty much what it is. Under these support floors, we have lots of stop losses and lots of sell stop orders. So the market is driven into these areas a lot because markets react from areas where orders are sitting. So it's very common that we see a movement down like this before we continue in the given direction. Now, if you have a collection of equal lows formulating around the low of one of the zones that you're looking at, it's very likely that this zone is therefore going to be an inducement zone, okay? So the easiest way to identify potential inducement zones is to just look, do we have points of liquidity underneath the zone that sit above the second zone? If we had equal lows like this, we would know there is a high probability that the market will be magnetized under this level at least. Therefore, making zone number 1 in this instance very low probability to buy from, and we should instead look to take trades from zone number 2, once the liquidity here has been taken out and the more considerable zone below has been filled. Now, obviously, you're not always going to be lucky enough to have very clear inducements like this, right? Sometimes it's going to be a little bit more difficult to identify whether this is a good zone to buy from or not. We're going to have examples just like what we looked at where zone 1 looks pretty clean as well. So there's another way that we can identify